In this video, we are going to talk about the structural models to predict the default, and of which we'll be taking up the Merton model, and we'll take up the example of one company, try to find what is the probability of default for that particular company based on the structural model. In general, when I come across structural models, they are typically cause and effect kind of model. So what do I mean by that? So I try to identify those kind of conditions where a particular company can default or a particular set of individuals can default, and I'll try to find out, I'll try to come out with an estimate of the probability that those particular conditions can occur, and this is what will drive the probability of default. Let's try to look at one simple company. So from a company's perspective, when we say default, it's like this: their assets value, the total value of their assets, is lesser than the total value of the liability that they are supposed to pay, right? So which means the debt value of the liabilities is nothing but their debt. If the value of their assets is not sufficient to cover the liabilities of the firm, then we say that this firm has defaulted, because we know that the total assets is same as total liabilities plus owner's equity, a balancing equation. Now, if this assets has gone lesser than the total liabilities, it means owner's equity is negative. So, if the equity value is negative, it's as good as we are saying the equity investors, they are taking a walkaway option. We don't want this company anymore. We are leaving this company to the lenders. We are leaving this company to the lenders and we will walk away. So the creditors who are the lenders to this firm, they are also not getting all they have lent, because the total assets of the firm are lesser than the total liabilities. So that is where the lenders are typically losing some portion of the amount, and that is when we say that the firm is in default. So what is the worth of this walkaway option? Typically, we can model it using the option pricing models. This is where we can bring in the Black-Scholes model, do the option pricing model, and whatever is the worth of the equity, right? We can very well find out the worth of the equity, which is the worth of walking away option, right? So that's how the structural models do come up, and based on this structural model, we can even find out the value, the probability of default of the company. Let's try out. So the basic thing that we are making as an assumption in the structural model is, whenever we are referring to default, it is occurring especially when the value of the assets is going below the amount of liabilities that are to be paid by the firm, which is leading to the value of the equity going negative. So this is the scenario where we are defining a default. So this the valuation of such kind of thing has been initially proposed by Merton, who is one of those founders of the Black-Scholes Merton based model. And here he has made a few assumptions while deriving or while applying the Black-Scholes model to the firm's default. He has made a couple of assumptions. One, whenever we are talking about the liabilities, these liabilities they consist of one zero coupon bond altogether. They don't have different kinds of liabilities. There is only one zero coupon bond with the total principal L. The total value of the liabilities is the principal and it is maturing at time period T. And the second thing what he says is there are no intermediate payments. We are only talking about time period T. There is nothing, no payment made by anyone in the middle because it's a zero coupon bond. So which means the equity investors, if at all they want to get any benefit, they have to wait until the time period T. And then only they have to see whether the walkaway option can be exercised or not. So they can't do anything in the middle. So, which means all these things put together, whenever we have to look at the probability of default, it is that particular probability where the value of the assets at time t is lesser than the value of the liabilities. Not anywhere in the middle. Only at the time t, which is the maturity of this debt, the value of the assets fall below the value of the liability. That is when we say the firm has gone into default. Now, looking at all these things, a few things. The liabilities. If I have to take it into a model, the liabilities of the firm, I'll get them from the balance sheet. Whereas with respect to the assets, I have to really model them. So I have to make some assumption regarding the distribution of the asset, especially at time t, because we are not bothered about any other period. At time t, when this debt is going to mature, what could be the value of the asset at that particular point in time? In general, the assumption is the asset values follow a log normal distribution. Right? In general, it is assumed that the asset values follow a log normal distribution, which means the logarithm of the asset values, they follow normal distribution. Correct? Anything that follows a log normal distribution, the logarithm of that is going to follow a normal distribution. So if I can make the logarithmic distribution of the asset price at time t, if it follows a normal distribution, we know the mean and the variance. Generally, let's take the variance sigma squared, and it depends on time to maturity, so I'll take it as time to maturity as t minus t. So t is the maturity date and t is the small t represents the period, the current time period. So we have a variance of this normal distribution sigma squared times t minus t. And what about the mean? The mean of such kind of a distribution, if you remember, the mean of a log normal distribution where the logarithm of it follows a mean mu and the variance is sigma squared, I can very well take the mean of the log normal distribution as mu minus sigma squared by 2. So applying the same logic, so it would become mu minus sigma squared by 2 times t minus t, and we are also talking about it is dependent on the log a. So I'll take it as log at, which is the current time period plus this. So the mean of it, because this is the drift parameter, so I'll take whatever is the current log asset price and at time t, if I want, there is still t minus t period, and this is the drift parameter. So I can very well say at that particular point the logarithm of the asset prices follow a normal distribution with this much mean and this much variance. Now based on this, I can very well compute compute the probability that any normal distribution value falls below a particular z value, right? We can very well call it as we can use our normally distributed norms dist kind of an equation formula in Excel, which is nothing but it is z minus the mean expected value of x divided by the standard deviation of x. So I know the expected value, I know the standard deviation. So it so goes that if I have to compute the probability of default, I'll take it as norms dist, the standard normal distribution value associated with the value of the liabilities. Right now we are getting in the z value, the assets value falling below the value of the liabilities. So the value of the liabilities I am taking them as log L minus expected value of x. What is the expected value of x? Log AT plus mu minus sigma squared by 2 times t minus t. This is right. So this is the expected value of x. Sorry. And divided by the standard deviation. We have already got the variance as sigma squared t minus t. So the standard deviation will be sigma into square root of t minus t. So I'll get this as the probability of default. If required, I can combine these two things. And I say that the probability of default is nothing but the log L by AT plus mu minus sigma squared by 2 times t minus t divided by sigma root t minus t. So this is how we can compute the probability of default. Now, once I know the probability of default, we can even introduce another term called distance to default, which is quite commonly used in this applications case. They call distance to default DD, which is nothing but it's the number of standard deviations any expected value of the asset at time t is away from default. How many standard deviations the value of the asset at time t is away from default? The higher is the value, the less the chance of default, the lower is it, the more the chance of the default. So typically the distance to default comes out with the reversal of this, which is nothing but by how much extent the value of the asset at time t. This is the value of the asset at time t. This is the distribution it is going to take, right? So the value of the asset at time t is nothing but log AT plus mu minus sigma squared by 2 times t minus t. This is the value of the asset at time t. And I am looking at default means log L, which is the liabilities. So this we are adjusting it with respect to the standard deviation. So this is giving me the distance to default, which means if I link this equation with this equation, it's nothing but probability of default is nothing but the standard normal distribution value associated with minus the distance to default, because it's just the negative of this. Negative of this is what is the input here. So probability of default directly comes from the negative of the distance to default. So if I have all these values, if I can collect the log AT values, if I can collect the mu is nothing but the drift part, then sigma squared is the variance, right? Sigma square is the variance associated with the asset values. AT is the value of the asset at time t, and L is the liabilities. If I am able to collect all this information, I can compute the distance to default, and from where I can very well compute the probability of default. But a few things. How can I get AT? Value of the asset. Asset is not traded in the market, right? Asset is not traded in the market. So I can't observe the daily market value of the asset. All I can get is only the book value of the asset, which are generally updated every quarter. So I'm not getting the latest value of the asset because they are not published on a daily basis because of the lack of the trading. So the book value need not be the same as the market value, right? So I cannot get this AT. I need to have some other mechanism to get this AT. Similarly, sigma, if I can't get AT, I can't get the volatility of the asset also. Only when I see that the prices are changing, that is where I am deriving the volatility of the asset. So here, because the price of the asset is not observable, I cannot even get the volatility associated with the asset also. This is where the option pricing is coming into picture. Otherwise, we really don't need any kind of option pricing formula. As long as we are able to find out AT and sigma, we don't need any other support. We could have directly looked at the normal distribution value, probability that the value is falling below the log L, and that is where we could have directly evaluated the probability of default. Whereas here, because we can't observe AT, and because of that the volatility of the assets cannot be understood, we are relying on the option pricing theory, because we are trying to build a relationship between the AT, which is the price of the asset at time t, and the volatility of the asset. We are trying to build some kind of a relationship between these and trying to link them with something that we can observe. The general things that we can observe are the value of the equity at time t is observed. The volatility of the equity can be observed. So we'll try to build some kind of relationship between this and this so that these values can be derived, and then we can very well use them into the equation. So for any publicly traded firm, I can get the value of the equity, and from the value of the equity, I can very well try finding out what is the historical volatility that is associated with the equity. So if I am able to link the equity values with the asset values, then probably these values can be derived, and then I can use these values as a part of my Black-Scholes Merton model formula for valuing the probability of default using the option pricing formula. Right? So that's the major intention here. So we know that the value what the equity investors are going to get. Can I say something like this? This is the maximum of whatever the value of the asset at time t minus the liabilities or 0. If the value of the asset is greater than the liabilities at the maturity date, then if the value of the assets at the maturity date t is greater than the value of the liabilities, then the whole debt will be paid off, and whatever is the balance that goes to the equity investor. So that is where we are saying the equity investor will receive AT minus L. But if the value of the AT, value of the asset at time T, goes less than the liabilities, then the value of the entire value will go to the lenders towards the liability payment. The equity holder will be receiving zero. He will go away, he will walk away, where he will walk away handing over the entire firm to the creditors only. So if you look at it, the value of the equity is looking like a European call option, right? This is where the option pricing theory is coming into picture. So this is very similar to the payoff on a European call option. So this I can look at as the underlying. For the call, the underlying is nothing but the assets of the firm. The strike price is nothing but the liabilities, right? The strike price X I can call as the liabilities. And from here, if I have to understand what is the payoff that the bondholders are going to get, it is nothing but it's a kind of a risk-free zero coupon bond, and along with so which is having a principal of L maturing at time T, along with a short position on the put, a short put position on the firm's assets with a strike price L. So this is what a bond investor is going to get. This is what is the payoff of a bond investor. This is what is the payoff of an equity investor. So probably let's first look at the equity investor, because this is following a European call option. I can use the call option Black-Scholes formula. I know that the value of the call option, which is the value of the equity at time T, should be, so typically S naught ND1 minus X e power minus RT ND2. Now here we know that S naught is nothing but the AT, value of the asset at time T. ND1, I can still go it in the same way, ND1 minus X, the strike price. So here the strike price is the value of the liability. So L e power minus R T minus T and D2. Now we know what is D1 and D2. D1 is nothing but log the spot price by the strike price. So which means AT by L plus R plus sigma squared by 2 times T minus T divided by sigma root T. If I directly model the same in a spreadsheet, I can get my D1, and D2 goes as D1 minus sigma square root of T minus T. So I get these numbers. So based on this, if you see the value of the equity, I am linking with the value of the asset. So there is the linkage. And along with that, even this sigma is coming in here, because we are talking about a D1 here. So once in the computation of D1 the sigma is there, and even in the computation of D2 also the sigma is there. So these two are entering into the equation of ET. But the only thing is, this is one equation. I don't have a second equation. I have two unknowns. AT is unknown, sigma is unknown. But ET is known because we are observing the values of the equity in the marketplace. So there is a one relationship. This option pricing model is giving me a relationship between ET and AT and sigma. But I need one more relationship, because this is only one and I can't solve the two equations using this one single relation. Right? So this is where we are looking at the second equation for support, wherein we have another relation which we use. The value of the equity times the volatility of the equity is same as the value of the asset times the volatility of the asset multiplied by ND1. There is one more such kind of a relation. So value of the equity and the volatility of the equity, value of the asset and the volatility of the asset. So basically if ND1, the logic is like this. If ND1 is 1, it's as good as the liability is almost negligible. That is when ND1 goes equal to 1. In that case, the relation value of the equity times the volatility of the equity should be the same as value of the asset times the volatility of the asset. So this relationship is what is providing the support for our second equation. So from here I can very well take the value of the equity, the other value for the equity, or probably if I am talking about the volatility of the equity, I can very well link by getting it here. So value of the asset times the volatility of the asset multiplied by ND1 divided by the value of the equity. So again here the D1 is the regular Black-Scholes formula. So if I know the value of the equity, I can now very well get the estimate of the volatility of the equity also. I can observe from the market. I can compute from the market. So now we have two equations between ET and the two unknowns AT and sigma. Using some kind of optimization techniques, I should be able to arrive at the computed values of AT and sigma, and once I know those values I can put it into the original formula which can really help me in trying to assess the probability of default. So that is what we typically go ahead when we are executing the same in a spreadsheet. When we are trying to create the model to assess the probability of default of any particular firm, this is the process that we are going to take up. And here a few important things. The time horizon, we are taking it as T minus T period. Generally, we can set it to 1 year to find out what is the probability of default of the firm in the next 1 year. I pull out the data of equity from the stock market. For the liabilities, I take the book value of the liabilities, and regarding the sigma E, I can very well find out the historical volatility from the observed market prices. So that is how we will proceed. So what we'll do is we'll take up one company. I am picking up Reliance Industries. Again, this is just for academic purpose, right? Reliance Industries Limited. I am trying to pick up their data set. So the liabilities are picked up from their latest balance sheet. The stock prices, equity prices are typically carried over the last calendar year from 1st Jan 2015 to 31st December 2015. That is what are the equity prices calculated picked up. From there we are trying to assess the sigma equity, right? And so one more what? We are getting the liabilities and risk-free rate of return. I am taking them as hypothetical 7.25%, which is something associated with a 1 year treasury bill rate. So I have picked up 7.25% as a measure of the risk-free rate of return. So this would be the initial information to go ahead with. So let's start our modeling process. See to what extent we can try to find out the probability of default. Alright. Alright. So this is a collection of the stock price closing. I'll take the closing stock prices year on day, right from 1st Jan 2015 till 31st December 2015. So based on this, I'll find out the logarithmic return to start with. So the log returns, if I'm finding out, I'm using the logarithm of the current day's price divided by the previous day's price. So these are the log returns of Reliance. Alright, I'm converting them into percentages just for my quick look. So I've computed the log returns here. And I'm also taking the standard deviation because I'll take the volatility. So I'll say daily volatility is coming out through the STDEV. I'm taking the sample standard deviation, getting the daily volatility, working out to around 1.74%. So from here I convert annual volatility. Generally it's nothing but the multiplication of the daily volatility by the number of square root of the number of trading days. So the number of trading days probably I can even count from this list. Because this is an annual data, I'll count the number of trading days from here. So this is giving me the annual volatility of Reliance. So this is telling me that Reliance carries in the last 1 year, Reliance has carried an annual volatility of 27.39%. Fair enough. So this is one side of the story. Then we are going ahead in terms of building the model. So what all do we require to build our model? The first thing we require is, so some of the assumptions that we have made, the value of the equity. The first thing I require is the value of the equity. I'll also, so this is nothing but the market value or the market capitalization. Then I am looking at the equity volatility. So I get equity value ET and equity volatility at time T. I can directly pick up to be this number, equity volatility. I'll pick it up to this number. Then liabilities, we'll try to get it from their balance sheet, the latest liabilities. Risk-free rate of return, I'll pick up the risk-free rate of return. As I said, I'll take it as 7.25%. And we'll try to find out the T minus T, which is the time period to default. I'll take it as 1 year. What is the probability of default in the next 1 year? So let me try visiting their annual report to get both the stuff, right? So let me go to the balance sheet directly. Okay, the total liabilities. I'm looking at the total liabilities here, both current, non-current, everything put together. So this is in crores. So I'll take the total liabilities. So this is the current liabilities, this is the long-term liabilities altogether. So I'm taking the total liabilities as 74,926 plus 95,566. So let me take that as the total liabilities, those many crores. 74,926 74,926 plus 95,566. So this is what I am taking as their total liabilities, both the non-current as well as current, from the latest balance sheet, 31st March 2015 balance sheet. I am capturing this important detail. Now, coming to the value of the equity, I know if I am trying to find that out as on 31st Jan, the share price is this much. All I need is the number of shares. So let's try to find out the number of shares that are there. So if I go here, I'll find out, I'll get the number of shares that are outstanding, right? So these are the number of shares. So 32356. So probably the number of shares, if I'm looking at, it is 3236 crores rounded up. 3236 crores is the number of shares that are outstanding. So 3236. So probably equity value is coming out as 3236 multiplied by this number. So this many crores is the value of the equity, right? Equity value is coming out to almost 32,000 crore, 32,000 crores. Sorry, 32 lakh crores, 3 million crores, whereas the liabilities are coming out to 1.7, are probably 1.7 lakh crores, right? This is the number of equity shares. Let me just say, yeah, equity is in crores. So these are the number of shares. So this is what is the value of the equity. This is what is the value of the liabilities. So based on this, I'll also try to find out the asset value. So to start with, I'll go with the asset value as the value of the equity plus the value of the debt. So I'll take this as the value of debt, this as the value of equity. So this is going on to be the total asset value, right? Let me just confirm this stuff. All right. I don't think we have made any mistake in terms of the total computation. Fair enough. So this is the value of the asset. Now based on that, I will take the asset volatility. I have to compute. We have already given the equation for asset, I mean the link between the asset volatility and all. We have simply said equity, value of equity into the volatility of the equity is same as the value of asset times the volatility of the asset times ND1. So the base start for me is, I'll assume ND1 equal to 1. So using that, I'll try to find out the asset volatility as nothing but value of equity multiplied by the standard deviation of equity divided by the value of the asset. So I can take that as a base. So I'll start it as value of equity multiplied by the value of the volatility of equity divided by the value of the asset. So I am taking this to be the asset volatility to start with. Fair enough. Now But remember, these all will keep changing. This is what my Black-Scholes formula I would be using here. So let me try out. So first for the Black-Scholes formula we require D1, which we have already applied earlier, log AT by L. So log AT is this one divided by L plus R plus sigma squared by 2 multiplied by T minus T. So T minus T is anyhow 1, fair enough. And this whole thing divided by sigma root T. Divided by sigma is the asset volatility here, square root of T. So this is what is working out to be my D1. D2 comes out as D1 minus sigma root T, D1 minus sigma into square root of T. This works out to D2. And based on this, equity value is nothing but the value of the call option, right? So probably first let me find out ND1, which comes out as the norms dist function associated with this particular value. ND1 is very close to 1 and ND2 also goes very close to 1. But not necessary in all the cases, because here the value of the equity is quite higher compared to value of the debt. I don't see any chance in the firm defaulting at all. Now this is the reason I see ND1 to be this much, ND2 to be this much, and based on this I can get the value of the equity. Right? Based on this I can very well get the value of the equity using the, because this is a call option, which is nothing but asset value times ND1, right? Asset value times ND1 minus x by e power rt. X is nothing but liabilities. Liabilities by e to the power of rt, which is t minus t, times nd2. This is my nd2. So my equity value through this formula is coming out to 328, and even I can apply the same formula, the equity volatility through this formula. So this one is actuals, right? This one is actuals. This one is derived from our formula. Similarly, equity volatility also, I'll go with the same logic. We have this formula, right? So from here I'll try to find out the equity volatility by taking the ET here. AT is sigma ND1 by ET. AT sigma ND1 divided by ET. ET, I'll be taking now the value of the equity that I got here. So this is telling me that the equity volatility through this process is slightly different, 27.29. Here it is 27.39. Now I want to really minimize the stuff. So that's where I'll see, okay, what the error between what we have really observed versus what is computed. That is what is the error part. And what I want to minimize is the total error altogether. Now this is where what I am saying, the error that I am trying to compute is the ratio of this value, the formula computed value to the actual value which we have observed, minus 1 squared. 1, this is for the value that I am doing it. Similarly for the volatility also I am taking the squared error. this divided by this minus 1 square. So I'm calling this particular stuff. So let me make it. So this is the error that is currently existing. What I really want to see is, can I minimize this beyond the limit? So just as a quick thing, we are solving the Black-Scholes equation, right? We have provided the input data that we have observed from the market, the equity value. From there we computed the equity volatility. We took the liabilities from the balance sheet. So we have all these things. And based on them, we have made some initial assumption regarding the asset value and the asset volatility. Asset value, we started it as the summation of the equity value and the liabilities value. Whereas asset volatility, we have assumed ND1 to be 1 and then use the remaining things to come up with the volatility. So, and based on that, we have got into the option pricing formula, used D1, D2, ND1, ND2, all that stuff, right? And now we have tried finding, we want this value to be as much close to the current equity value, and I want this to be as much close to this. Based on this, I want the remaining values, the asset values and everything else to be adjusted. So that's where I want the error to be as little as possible. So now I can very well go ahead in terms of executing the solver, right? We want to minimize the stuff. So the asset value I want to be reworked. So initially we started off with this assumption, but this needs to be reworked. Now this is where we'll go ahead in terms of solver, which will help me in terms of minimizing this particular error. I want to minimize this particular error. Can I reduce it by some extent? Wherein I want to change these two numbers. The asset value and the asset volatility I want to change. And I want I can solve it directly. But probably it's better that if I can set the options where the precision could be much, okay, I can put the precision to be much smaller because this is very small kind of a value. We can have a much bigger precision, and I can very well go ahead with this. Let's try solving it. Okay, we are able to minimize the error, right? The error came out close to 0. The asset value became this much now. Earlier we started off with an asset value which is the summation of the two. Now probably it may not be the summation of the two. If I still sum up these two things, it is 3447266, whereas here it is coming out to 343. So the asset value is slightly lesser, right, than the typical summation. So there is some change in the asset value. And even in the asset volatility, when we have taken earlier, it was now it is a simple computation on right now it's a simple computation based on your ND1 and all. So this is what is working out to be your asset volatility. Fair enough. And now this is where we get into the default probability computation. Right, we have ND1, ND2 and all are there. If you remember, the probability of default is nothing but n of minus d2, right? So which is 1 minus nd2. So 1 minus nd2 is the probability of default. So probably if I go slightly more detail in expanding it, yeah, probably it's very close to 0. The probability of default in this kind of a situation is working out very close to 0. So that's how we are using this model, right? So we are using the estimate of the equity volatility from the estimate of the prices, and we are from there we are doing the equity volatility estimate, and we are directly pitching them into the formula. So this is how we are using the Merton model to estimate the probability of default. So a company like Reliance, the chances of defaulting within the next 1 year are very, very, very close to zero, which is obvious, right? Now the same logic we can use for any of the companies, and especially for 1 year kind of a horizon, I can go with this kind of an aspect by for doing the detailed probability of default computation. We can extend this model even if I really require for not just for 1 year, for a T period kind of a horizon, but that will take up as a part of what all modifications are required if I have to go for a T period horizon. We'll take it up as a part of our next video. I hope you have enjoyed and got a good understanding on using the Merton model to find out the probability of default. Thanks a lot for listening to this session.